Welcome to the video on accounts receivable that shows how companies compute and how they account for the allowance for uncollectible accounts. We will start with a base case of a company that uses the balance sheet approach to compute the allowance and that distinguishes between two kinds of receivables. The first is overdue and the other is non-overdue. Of course, if there were more than these two categories, then the solution would be very similar and it would directly follow from the discussion that we have in this video. In addition, in the base case, we will have a company that is fairly precise in its estimation about the proportion of receivables that will end up being uncollected. In the other two examples that are included in this video, we will modify this assumption and we will consider a case where the company is overly pessimistic, and then we will consider a case where the company experiences a significant unanticipated write-off of receivables. We will divide the problem into three phases. The first phase will observe the company at the end of year 2000, when the company measures its receivables and sets up the allowance at the desired level. The second phase will observe the company in the year 2001, when the company will make three kinds of transactions. First, it will make credit sales, then it writes off some receivables, and finally it collects some receivables for cash. The last phase will observe what happens to the company at the end of year 2001, when the company measures its receivables again, sets up the allowance, and recognizes the bad debt expense. At the end of year 2001, the company will also need to measure the net level of receivables, because the net level is going to be reported on the balance sheet. As you will see, what happens at the end of 2001 will be somewhat similar to what happens at the end of 2000. This is what we know about the situation of the company at the end of the year 2000. The company has total gross accounts receivable of 270, out of which receivables worth 70 are overdue. In addition, based on its past experience, the company set up the following bad debt policy. It understands that the overdue receivables are much less likely to be collected, and therefore it sets up the allowance at 20% of the gross amount for the overdue receivables. The non-overdue receivables are more likely to be collected, and therefore the company requires only 4% of the gross amount in the allowance. Now our task is to record the gross amount of accounts receivable at the end of year 2000 and the allowance for uncollectible accounts at the same time. We will solve the first phase of the problem in two steps. First, we will compute the amount of receivables at the end of year 2000 that are and are not overdue, and second, using the bad debt policy, we will compute the allowance for uncollectible accounts. So we see the computation of the overdue and non-overdue accounts is very straightforward, because we know from the assignment that the company has total receivables worth 270, and out of that 70 is overdue. Therefore, the amount of the non-overdue account is just the difference between the two numbers, that is to say 200. Then we also know that the company requires 20% allowance for the overdue accounts and 4% for the non-overdue accounts. So 20% of 70 is 14, 4% of 200 is 8. These two numbers add up to 22. It would be good if you remember that number, because we will return to it a couple of times. Let us now see how the computation will be reflected in the company's T accounts. So we know that the total receivables at the end of year 2000 is 270, and in the second step we have computed the allowance that will be required to be equal to 22 at the end of the year. Now, obviously, the allowance for uncollectible accounts is a contra asset account that makes an adjustment to the gross accounts receivable. So in case we are interested in the net amount of receivables at the end of year 2000, we need to take 270 and subtract the 22. We get the number 248. To make the book balance, we can record the 248 in contributed capital. Now in the second phase, the company makes 3 transactions during the year 2001. First, it makes some credit sales worth 840, then it writes off receivables worth 20, and finally it collects for cash receivables worth of 790. Our task will be to first of all record the transactions of 2001 in the T accounts, then compute the gross amount of receivables at the end of year 2001, and then compute the temporary level of the allowance before we make the adjustment for the desired level of the allowance that is required by the bad debt policy. Before we start computing, it is good to look at the numbers to get a rough estimation of where the result should actually be. So 2 things are worth noting. First of all, the company it creates gross receivables by the first transaction, whereas it reduces gross receivables by the other 2 transactions. As you can see, 840 is larger than a 790 plus 20, that is to say 810, and therefore we expect an increase in gross receivables as a consequence of these transactions. The second point that is worth noting is that the company is fairly precise in its prediction about the amount of receivables that end up being uncollected. Remember that at the end of year 2000, the company set up receivables worth of 22. Well, we actually see from here that the company will write off receivables worth 20. So its bad debt policy ends up being only slightly conservative relative to the actual write-offs. So let us now see how the transaction will be recorded in the company's T account. So here what we can see is the situation that we have ended up at the end of phase 1. The gross amount of 270 is offset by the allowance of 22, and the net amount 248 is recorded in the contributed capital. Now the first transaction was the credit sales worth 840. Well, the credit sales of course are revenues that will be booked against accounts receivable of 840. The second transaction is the write-off of some receivables. The write-off of course decreases the gross amount of receivables by the value of 20, and since the company is using the allowance method, it will record the write-off against the allowance it set up earlier. So what you can see here again is that the allowance was initially 22, now the allowance decreased by 20, so the temporary level of the allowance is only 2 at this stage after transaction 2. The third transaction was the collection of some receivables worth 790 for cash. So obviously that transaction reduces receivables, there is a credit on receivables, and correspondingly there is a debit on cash because now the company has cash rather than receivables. So what effect will these transactions have on the receivables and on the allowance? So when it comes to the gross amount of accounts receivable, remember that we have started with 270 worth of receivables at the end of year 2000. We have made credit sales of 840 that are going to be add up to the gross receivables, and we have written off receivables worth of 20 that obviously decreases the level of receivables. In addition, we have collected receivables worth 790, which again decreases the level of receivables. So this brings us to the gross amount of receivables at the end of 2001 of 300. Now, what will be the carrying amount of the allowance for bad debts before we actually recognize the bad debt expense for the year of 2001? Well, we have started with the allowance worth of 20 at the end of the year 2000, and we have written off bad debts worth 20, and so we end up with the carrying amount of 2 that will then need to be incremented to achieve the desired level of allowance at the end of 2001. So let's assume that the company makes no changes in the bad debt policy. So it will still require 4% for the non-overdue accounts and 20% for the overdue accounts. And then let's also assume that 1/3 of the receivables is overdue. Our task is to recognize the bad debt expense for year 2001. So these are the individual tasks. We will first need to compute the desired level of allowance. Then we will compute the bad debt expense. That will be the difference between the carrying amount and the desired level. Then we will record the bad debt expense in the T accounts. We will compute the net level of accounts receivable, adjust it for the new allowance, and then we report the receivables on the balance sheet. We will solve phase 3 of our problem in 3 steps. First, we compute the required allowance at the end of 2001. Then, we compute the bad debt expense as the difference between the required level and the carrying level of allowance before the end of 2001. And then finally, we will compute the net accounts receivable as the difference between the gross amount and the level of the allowance. So starting with the required allowance, we know that the company has receivables worth 300 and 1/3 of that is actually overdue. So from that it is clear that 1/3 of 300, 100 is overdue, the remaining 200 is not overdue. So relative to the situation at the end of year 2000, we have the same amount of non-overdue receivables, that is to say 200, but before we had only 70 in overdue, now we have 100. So what we will expect is that the required level of allowance is going to increase because we now have more overdue receivables. So let us now compute the desired level. The company maintains its bad debt policy requiring 20% of the overdue, 20% of 100 will be 20, and 4% of the non-overdue, 4% of 200 will be 8, the sum of the two will be 28. So remember that we are moving from a situation where we have required 22 to a situation when we require 28 for the allowance. Now, how much incremental allowance will be needed to reach this new desired level of 28? Remember that we have concluded that starting from 22 and writing off receivables worth 20, we end up with the temporary level of allowance at 2. So if we have 2 and we want to reach 28, we need incremental bad debt expense of 26. Now, what's going to be the net level of accounts receivable at the end of year 2001? Well, we know that the gross receivables are worth 300, and we also know that the new level of allowance is 28. So the net amount of receivables at the end of year 2001 will be just the difference between the two numbers, that is to say 272. Let us see how the bad debt expense is going to be recorded on the balance sheet. So what I now show is the 3 transactions that have been added to the accounts receivable and to the allowance over the year, And what we need to do now is to record the additional entry for the bad debt expense. So bad debt expense is obviously something, is one of the expenses. It will affect the income statement and it will be recorded against the allowance for uncollectible accounts. This entry will actually increase the allowance, and since the allowance is a contra-asset account, increases our credits and decreases our debits. So the debit in the bad debt expense will be recorded against the credit in the allowance for uncollectible accounts. As you can see, the net level of receivables will be just the sum of these numbers minus the sum of these numbers. You can add these up and you will see that it is actually equal to the 272 which we have computed in the previous slide. You probably know that if you open annual report of a company, then the company will report the level of accounts receivable net of the allowance for uncollectible accounts. So what we have here is a scan of one section of the balance sheet of the company Cisco Systems, and what you can see is the entry that reads accounts receivable net of allowance for doubtful accounts worth 162 at July 30, 2005 and 179 at July 31st, 2004, right? So these numbers are the net numbers from which the 162 and 179 have already been subtracted. So we want to reach a similar entry for our fictitious company. How to do it? Well, we know that we have required the allowance of 22 at the end of year 2000 and allowance of 28 at the end of 2001. So if we take the gross amount of 270 and subtract the 22 at the end of 2000, we get to 248. And if we consider the gross amount of 300 and we subtract the 28 at the end of year 2001, we get to 272. So this would be the way how the information about the level of accounts receivable would be reported in the annual report or in the balance sheet for year 2001, which typically contains information at least about 2 fiscal years. The last fiscal year that is typically reported first, and then 1 or 2 preceding fiscal years. So now we have concluded the base case where the company made a fairly accurate forecast for how much of its receivables will not be collected in the coming year. Remember that at the end of year 2000 the company set up an allowance of 22, and in year 2001 it actually wrote off bad debts of 20. So there was only a difference of 2 that differed between the expectations and the realized write-offs. Let's now consider the case when the company is too pessimistic about its forecast concerning the collectibility of its receivables. So let's assume that the forecast will actually set up allowance that will be 1.5 times as large as it was in the base case. So let's assume that for the overdue accounts, the company will require 30% rather than 20% of the gross amount of receivables, and for the non-overdue accounts it will require 6% instead of 4%. Now our task will be to discuss what accounting numbers will and will not change as a consequence of this higher allowance, and then what implications the highly pessimistic allowance will have for firm performance in year 2000 and in year 2001. Before you start computing, it makes sense to think through what the likely implications are going to be. In particular, first think about what should not change as a consequence of the new debt policy. Consider that the bad debt policy only concerns the expectations or the assumptions, and therefore nothing changes with the real transactions. And therefore the gross amount of receivables should not be affected. What will be affected, however, is the magnitude of the allowance and correspondingly the bad debt expense the company will recognize in year 2001. When it comes to the second question that addresses the impact of this change on the firm performance, then what will matter is whether the conservatism or the pessimism about collectibility of receivables will persist between 2000 and 2001, or if the company learns about higher collectibility of receivables in 2001 and actually adjusts the policy. So let us now look and compute let us now look at the specific numbers. The first question is, what implications will the new bad debt policy have on the allowance for uncollectible accounts for at the end of year 2000? So we apply the new percentages, the 30% for the overdue accounts and the 6% for the non-overdue accounts, for the initial level of 200 of non-overdue and 70 for the overdue, and we get the 21 plus 12 totals to 33, right? Remember that initially in the base case the allowance at the end of 2000 was 22. Now it is 33, which is 1.5 times 22. That is rather natural, given that we have increased the percentages from 20 to 30 and from 4 to 6%. The second question is, what will be the level of the allowance account before we actually recognize the bad debt expense for year 2000? So in this case, if we consider that the write-offs will remain at 20, we start with the initial allowance at the end of 2000 of 33, we subtract 20, and we end up with 13. So that will be the number, the amount of uncollectible accounts, or the allowance for uncollectible accounts, that the company will have towards the end of 2001 before it will actually recognize the bad debt expense. Now, remember that initially this number was only 2, right? So the company was very precise in predicting how much of its receivables will not be ultimately collected. Now it is 13, so it is higher by 11, and 11 is also the difference between 33 and 22. So another way of presenting that result is to say that the company has overstated its expectations about bad debts, not by the factor of 2, but by the factor of 2 plus 11, that is to say 13. The second question we are asked to address in the pessimistic forecast scenario is the effect on the company's earnings in year 2000 and 2001. Now the answer to that question will depend on whether the company will remain conservative or pessimistic about its collectibility at the end of 2001, or whether it will adjust its policy and switch back to the more realistic 20% for the overdue and 4% for the non-overdue. Let us first consider the case when the company remains pessimistic about its ability to collect receivables. In such a case, it should keep its pessimistic bad debt policy, requiring the allowance at 30% of the overdue accounts and 6% of the non-overdue accounts. At the end of 2001, the company has 100 in overdue accounts and 200 in non-overdue accounts. Applying these percentages brings us to the required allowance of 42, which is significantly higher than the initial 28. This is primarily driven by the fact that relative to year 2000, at the end of 2001, the company has 100 worth of overdue accounts relative to the 70 in the year 2000, and the higher percentage that is required for the overdue accounts, 30 instead of 20, is actually significantly increasing the amount of the allowance that is needed to set up to cover the overdue accounts. What will be the bad debt expense under this scenario? So remember that on the previous slide we have concluded that before creating the bad debt expense for year 2001, the company has allowance or remaining allowance of 13. Now at the end of 2001 it will require to have the allowance of 42. So what it needs to set up is just the difference between what it has towards the end of 2001 and what it requires to have at the end of 2001. So 42 minus 13 is 29. So you can see that even though the company has started from a higher level of allowance towards the end of 2001, it's 13 instead of 2, the higher required level of allowance at the end of 2001 actually dominates the effect, and the required bad debt expense is higher under this scenario than what it was under the base case where the company kept a fairly realistic bad debt expense policy. Now let's consider the second case, when the company realizes at the end of 2001 that it has been too pessimistic about its ability to collect receivables, and it switches to the more realistic bad debt policy that requires only 20% of the overdue accounts and 4% of the non-overdue accounts to be counted towards the allowance for uncollectibles. Okay? So under this scenario, of course, the desired level of allowance at the end of year 2001 will be 28, exactly as it was in the base case. Now, what will be the bad debt expense? Well, the company wants to reach the same level of allowance of 28 in both the base case and in this case. However, in the base case, it only had 2 because it has written off bad debts worth of 20 and it set up allowance in 2000 worth of 22, so there was only 2 left in the allowance account before the company was setting up the allowance at the end of 2001. Now you may say that the company was positively surprised by what happened over 2001. It had created an allowance of 33, but it actually only used 20 out of the 33, so there was 13 left before it started increasing the level of allowance to the desired level of 28 that is required at the end of 2001, right? So the incremental bad debt expense is only the difference between 28, the desired level, and the 13 that is the leftover after the company has written off all the uncollectible accounts for 2001. So the additional bad debt expense that is needed is only 15. Initially it was 26 if you look back at the base case scenario. Note that the difference between 26 and 15 is 11. 11 is also the difference between 33 and 22. That is to say, the allowance that was set up under the new pessimistic forecast scenario and the old base case scenario. So let us draw some general conclusions from this computation. If we assume that a company is trying to update its bad debt policy considering the most recent evidence about its ability to collect receivables, then we can say that in the year when the company is overly pessimistic about its future ability to collect receivables, there will be 2 effects on the company's accounting. First, the company will recognize larger bad debt expense than what it should, which will increase the expenses and lower the earnings or the profit. That will be the income statement effect. On the balance sheet, the company will recognize larger allowance for uncollectible accounts. Remember that the allowance is a contra-asset account, so the net level of receivables will be actually lower in case we have a larger allowance. Therefore, the total assets will actually be lower. So both the income statement and the balance sheet will be more conservative in the year when the company is overly pessimistic. In the following year, however, we will have offsetting effects. So, in contrast to the first year, the company will recognize lower bad debt expense because it will be able to benefit from the fact that it has a greater allowance than what it actually needs. So some of the allowance will not be fully exhausted, which will directly impact on the need to create additional expenses in the coming year, in the year 2001. So this will obviously increase the company's earnings in year 2001. In addition to that, the assets on the balance sheet will revert to the normal level. So they would be depressed in year 2000, and then year 2001 they will revert to the normal level. So in this sense, the balance sheet method is automatically self-correcting. If you overstate your allowance in one year, there will be less need for additional expenses in the coming year, and the effect will cancel out. Now note that the very similar situation would occur in case the company was realistic about its ability to collect receivables, but it turned out lucky and there were fewer write-offs in year 2001 than what was actually anticipated. The only difference would be that there would be an effect on the gross accounts receivable. Okay, that is because the write-off actually affects real transactions, and therefore there will be a direct effect on the gross amount of receivables, not only on the estimates. We will now consider a very similar case where the company will not have fewer write-offs, but actually will recognize one large write-off that was completely unanticipated due to the fact that one of its major customers went bankrupt. So this is the third case and the last case that we will discuss in this video, the case of a large unexpected write-off of receivables. So let us again assume that the company is back to the base case and it recognizes bad debts at 4% of the non-overdue accounts and 20% of the overdue accounts. So at the end of year 2000, it again sets up an allowance worth 22. Now in 2001, something quite unexpected happens. One of the major customers goes bankrupt quite unexpectedly, and that implies that the company has to write off receivables after this main customer worth of 80. In addition to that, it will write off additional receivables worth of 15, which is very much in line with the expectations. Now let us assume that the company believes that this case was very, very unusual and that it's very unlikely that in the future another major customer will go bankrupt, and therefore the company does not change its bad debt policy. What implications will this have on the company's accounting? So clearly there will be no effect on the credit sales, and there will be no effect on the collections. However, there will be an effect on the write-offs. The write-offs will be not 20 as in the base case, but there will be at 95. We are again asked to do the similar computation as in the base case. First to record the transaction, then compute the gross receivables, the temporary level of allowance before recognizing the bad debt expense, compute the bad debt expense, and then compute the net level of receivables that the company will report on the balance sheet. So let us see how these will be done. So this is how the T accounts for the transactions will look like. We start with the very same situation when we have 270 worth of gross receivables and we set up the allowance of 22 following the standard bad debt policy. The first thing that the company does over the year of 2001 is to recognize net sales of 840 that will be recorded as gross accounts receivable. After that, it will recognize the write-off of a significant amount of receivables, and the write-off will be booked against the allowance. So know that now the level of the allowance would actually be negative, 22 minus 95. I will in a minute show you that even though this is somewhat counterintuitive, if you record the transaction this way, it will not have any adverse consequences on your computation. The third transaction, the collection of receivables worth 790 for cash of 790, is the same as it was before. In the second step, we will compute the level of gross accounts receivable and allowance before the company recognizes the bad debt expense of year 2001. So the level of gross receivables will be actually lower than what it used to be in the base case. In the base case it was 300 at the end of year 2001. Now it will be only 225, and that is because we have more write-offs of gross receivables, which will lead to lower ending level of gross receivables. In addition, the large write-offs will have an impact, obviously, on the level of the allowance. We started with the allowance of 22 and we made 95 worth of write-offs, so the carrying level of the allowance is actually minus. In the second step, we need to compute the required allowance at the end of 2001, then the bad debt expense that this will induce, and then finally the net amount of receivables in 2001. So starting with the required allowance, know that now we will have a change relative to the base case scenario. The percentages stay the same, so the bad debt policy is still the same, but now we have fewer bad debts. In particular, we have only 225, out of which 1/3 is 75 and 2/3 is 150. So if we take 20% of 75 and we add 4% of 150, we get to 21. That is the desired level of allowance at the end of year 2001. What is going to be the need for the bad debt expense? Well, obviously that is going to be rather significant. We start with, or we want to end up with 21, that's the desired level at the end of 2001, and the level at which we ended after recognizing these large write-offs was minus 73. So in fact, we will need to recognize bad debt expense of 21 minus 73 plus 73, 96. Initially it was only 26. The huge difference is due to the large write-offs we had to do in 2001. So what will actually be the net level of receivables at the end of 2001? Well, it will be the difference between the gross amount and the net amount. The gross amount we have computed on the previous slide, that's the 225, and the allowance is 21, because that is what is required by this bad debt policy applied to the 225, which is the new level of gross receivables. The way these transactions are going to be recorded in the T accounts is going to be exactly the same as in the base case, but for the fact that now we have 95 worth of write-offs, and as a consequence of that, we need to recognize a much larger bad debt expense to make sure that the ending level of the allowance for uncollectible accounts is at the level that is required by the bad debt policy. So we will now need to recognize a bad debt expense of 94. Now note that under this scenario, the level of the allowance for uncollectible accounts after transaction 2 is actually negative, right? You may, if you are uncomfortable with that, we can modify this scenario to what is shown on the following slide. So this is how the T accounts look in case we do not want the allowance for uncollectible accounts to turn negative. So we start with gross receivables of 270 and the allowance of 22. We record the transactions as before, so we have credit sales of 840 and we have cash collections of 790. Now we want to write off receivables worth 95. We only have allowance worth 22, so we write off 22 against the allowance, we bring the allowance to 0, and the rest will be recorded as an expense in the income statement. So 95 minus 22 is 73. 73 will be the a debit entry in the income statement and a current expense. Now after we do this, we will need to bring the allowance to the level that is desired by the company using the bad debt policy. Remember that under this scenario, the desired ending level of allowance at the end of 2001 was 21. So clearly we need to recognize additional allowance of 21, which will obviously add up to the bad debt expense. So ultimately the total bad debt expense will be 94, which is exactly the same as it was in the previous slide, and also the net level of receivables, that is to say the gross minus the ending allowance, will be 204, which is again equal to what we get at the previous slide. So the conclusion from this is, it really does not matter if you recognize the entire write-off against the allowance and then make up for that at the end of the fiscal year, or if you only use up the allowance that you currently have and recognize the rest as a current bad debt expense. Alright, this concludes our discussion. I hope the video will be useful for you to better understand how companies account for receivables and how they set up the allowance for bad debts.